Okay, good morning. Well, I prepared by the direction a lecture on the Israeli economy, expecting people who are not local. And I have basically two topics. It's the macro picture, and I would like to emphasize the importance of innovation and the sort of startup nation on the macro picture. And then I talk about the high-tech sector in Israel in a macro picture. So I would talk about the whole story, the way we see it, and how great the story has been, and the bottom line is that the prospects are not that great overall on the macro picture with respect to innovation and the Israeli economy. So let me do it as a kind of what we say, when I used to be deputy governor, so it's kind of a very fast going through the economy. And what you see here is, I think, the key picture of the Israeli economy comparable to the EU 17 nations in red, and the blue is Israel and the US, and this, what you see, is the growth rate in a macro picture. We entered to the crisis growing more than 5% a year. This is a high, very high. And then there is a slowdown as the crisis started at late 2007. And, but as you can see, we have only 2 quarters of negative growth. Just 2 quarters of negative growth, and we were start growing back already in the second quarter of 2009. And you can see the growth rate of Europe has been nice, so you will see later what they did, but they are back into a negative area. Europe is projected this year negative growth. Very different across the peaks versus Germany, even basically 0 growth for next year. And if you go further, maybe going back to 1% growth. US, according to the IMF, has been growing this year by 2.2. Some other places are a little lower, and is expected by IMF 2.1. Some other projection a little higher. It's still way below what people think is the long-run US, about 2.5. Israel, which we were, through the previous decade, kind of thinking in normal time to grow about 5%, is going down to a 3% growth. So I will tell you why. Basically, that's the key story why. The key story why is what happened in world trade. So what you have here is the growth rate of trade. So the growth rate of trade has been between 8 to 10% throughout the period before. And that was, it collapsed dramatically to a negative 10% in 2009. It went back, and we thought that we are doing well. And as you remember, the Israeli economy was doing fairly good, but the world trade is going down to 4%. At the 4% growth rate of the world trade, Israeli exports are not growing enough to push the Israeli economy up. And that is going on with the world growth is going down from something about 5–6% to less than 4%, mainly in the developed countries, but also in the developing countries. So growth rate, which was used to be in China about 10%, 9%, is going to the 8–7%. India, which was growing about 8%, going back to down to 5%, etc., etc. So the whole world is not as nice as it used to be before the crisis, and it's probably for the next decade is not going to be as growing as before. And we are part of the global economy, and we were growing mainly through the export sector. I think a key figure that we always look is the unemployment. Israel unemployment, we claim it was low. It has not been that low. Numbers have been adjusted by the Israeli Central Bureau of Statistics, and when we thought here that we were 6%, we were actually 7.5%. And what you see is really the projection of Israel as a growth rate goes down to 3%. Unemployment is expected this year to start going up. This is the projection of IMF to the US. Actually, the projection of the Fed and other agencies is to go below 8% in the US. EU is optimistic numbers. I think the last month number was 11.7, and it may be even going worse. Okay? So unemployment is in a bad shape, is reflecting what we say about the growth rate. Many people are unemployed. As you know, in Spain, 25% are unemployed, about the youth up to age 20 to 30, 50% are unemployed. The same picture is in Greece. Italy is in trouble, and what's going on in France is also a big unknown, and Germany and the North are doing well, but overall that's reflect the whole uncertainty in the world. The world is still under the shadow of the financial crisis, and especially the US is not out of it, and Europe is deep into the debt problems. However, we can say that the Israeli economy went through the crisis fairly well, and I want to say it very simply, and I will do it very quickly with you, from 4 legs of every economy: financial sector, no debt bubble, fiscal policy, decreasing debt to GDP, overall balance of payment, no deficit with a surplus, and price stability for monetary policy. Those are the 4 legs of every macroeconomy. We have to keep them strong and solid. In Israel, just to do it briefly, the financial sector is stable. We have a very reasonable debt. We have never had huge. We had some into the corporate debt, which was blowing up and causing haircuts and etc. now. But overall, not huge debt. Banks are solid, well-preserved stability with relatively high capital ratios. We have a large saving. People say that we are always in overdraft. No, actually Israelis overall are high saver relative to developed economies. And we were not using all these new instruments in the financial sector. As I used to say, when they were driving Corvettes, we were on donkeys. And in the financial sectors, riding donkeys was a good way to avoid getting into an accident with a Corvette. And that's basically the story in a simple of all these MBSs and CDOs and CDS. It doesn't mean that we don't have to move from the donkeys into a solid car, but that's a different story. And what we have is actually a real estate, almost a bubble now, coming up mainly from actually very low interest rate, but not only. The key factor is very bad planning of housing. But that's we have to keep in mind. I will get back to this in 2 minutes later on. Government fiscal policy, you see the green line. We were, when the Intifada, 100% of GDP. That was about where Greece was when the crisis started. Now they are 180. Italy was about there, now it's 120 or 110, etc. We were taking very strong measures in 2003 and enabling the debt to GDP to go down to 77% of GDP, and we took reasonable measures through the crisis and kept the debt to GDP flat where the rest of the world is growing. US deficit is about now it's about 8% of GDP, and that's the fiscal cliff, and it's probably the main shadow on the US and the world economy coming from there, on top of the shadows of debt that is growing up in most of the European countries, and mainly in the Greece and other countries, which in Spain and Ireland. In Israel, we kept the deficit, as you can see, at the height in 2009, getting to about 5.5%, but it's going down and keeping it reasonable. It's still, to the eyes of me and many other people, a bit too high, which require probably to increase a bit taxes, which would probably happen in 2013, to keep it to a 3% deficit in 2013. It may even need to be less in order to get the green line to stop growing even a little bit. It will continue growing even in a slow motion. Interest rate will start hiking up and the growth rate of the economy will go down. A key point of stability is the balance of payment. The key story of the Israeli success economy is the growth of export. And what you see here is the red line and the blue line. This is percentage of GDP. Say the message that export and import are huge relative to our activities. They are 45, used to be before the crisis. They are back to 40% of GDP. This is big. That means that 40% of our sales are competing in the world. 40% of the whole economy, which is about 50 or 55% of the total business sector in Israel, is in competitive world. It's competing worldwide. Most of it, a lot of it is high-tech, but it's balanced. And even that we have it going up and down, the import and export going together don't generate a current account deficit. You can see in 95 we had a huge deficit, and that was the perception of the Israeli economy, with a huge deficit and a lot of devaluations and playing with the exchange rate. Since 97, when we let the exchange rate to determine in the market, we had actually devaluation and increasing export substantially, matching import and generating current account surplus. Current account surplus, together with the stability of the economy, pushed the shekel to be very strong, and I will talk about this a bit later. But keeping the shekel strong, actually at the end, getting us back to about balanced current account. Monetary policy, basically, I just say to those who don't know, Israel has a new law from 2010, but has been maintaining the same policy even before the law. Price stability is the main goal. Target is 1 to 3%, very much like most of the developed economy. Secondary goal, it's like other developed economy, but also there is a support of financial stability and what is called macroprudential action, and I will mention this as I get to that in 1 minute. This is the inflation. It has been a roller coaster, and if I want to give a credit to the Bank of Israel and to the Governor, Professor Fisher, is that actually during the crisis, inflation was a little bit above the target. The range of the target is 1 to 3%. It was overall around, and we came back to the target. So that's very important. Why? Because on the one hand, high inflation goes with a very low interest rate, a very low real interest rate, which push investment and push investment of individuals and people from abroad and the business in Israel. And you can see that we haven't lost the credibility at the Bank of Israel. So what you see, the green line, is the expected inflation a year ahead. And throughout the crisis, even when the crisis started, people expected a deflation. But overall, inflation expectation reached the 3% during the crisis, but as we get out, inflation expectation going back to the central target, very strong confidence in price stability led by the central bank. If you look 10 years ahead, so this is after Professor Fisher will be here, most of the people who buy Israeli bonds, index and non-index, believe that the Bank of Israel would continue to keep inflation between 1 to 3%. That provides stability, helps the business sector, the individuals, the consumers to invest for the long run in Israel. It keeps the Israeli economy stable, which is a necessary condition to see that. In terms of the policy, as you can see, Israel reduced, like all developed countries, the interest rate very fast during the crisis. However, we were first to get out of the interest rate increasing, and the reason was that Israeli economy has been started growing already in the second quarter of 2009, and then we had increasing housing prices, and the Bank of Israel start increasing interest rate. But as the European crisis hit back, the Bank of Israel reduced interest rate and recently reduced it even further. So if you want to say it overall, we have a very expansionary monetary policy. In fact, you can see the Fed interest rate, the US interest rate is 0. The UK interest rate is 50 basis points. The euro area went the lowest ever, 75 basis points. Basically, this is expected to be held at that level through 2014 to the beginning of 2015. That means you won't make much money on putting your money in safe government debt. Interest rates are very low. Pensions are going to do maybe negative real return. However, business can make investments in a cheap price. Another thing we did in Israel is we changed the policy from 1997 to 2008, from 1998 to 2008, for 10 years, Bank of Israel never intervened in the exchange market. What you see in this graph is at the period around 2007, the Israeli exchange rate, this is you can read it here, right? So we started at a 4.5. Before, people in the audience remember, in the Intifada, we were 5 shekels per dollar. Very attractive to exports. It continued to go up, but then in 2007, it started going down very fast. We were at that time in the understanding that we are entering to a financial crisis, and that's the time that we changed the policy and the start intervention. And the intervention was very minor in the sense that we just start, at the Bank of Israel, start buying foreign exchange, basically buying dollars and saving them. At that time, Bank of Israel, the Israeli economy had about $28 billion reserves. Now there are $75 billion reserves. No. So what has happened is the bank was intervening and stopped just starting 25 million, then in July start buying 100 million, and then basically stop buying constant amount per day and intervene in the market to prevent this downfall of the shekel or the strength of the shekel going up. And in fact, at this time, in July 2011, just as I left the bank, they stopped intervening. No causality. And in fact, the shekel, and what is related is that basically at that time, the excess of export to import stopped, and the fundamental went back to equality in the current account. And basically, the intervention policy made 2 positive impacts on Israel. It prevented further negative effect on exports. So it, if you want, mild the impact of the strength of the shekel on the export in the short run, and it strengthens the Israeli long-term stability by having the economy cushion of $75 billion to a bad day. Okay, so that's the story of the macroeconomy, how that takes us to the innovations, and I will try to be as short as possible on that issues. So when you look at the Israeli export, what you see here is the exports of goods without services. By the way, just that people know about the data in Israel, computer services, software and other services on the computer is large. It's about $3.5 billion a year, but it is not into the export of goods, which we have the data here. What you see is a very exceptional story that in the following sense, that the largest share of total export is the blue line, is what we call high-tech or high-technology sectors. And this part has been growing from even before, all the way from the 95. And it has continued growing. You see, even the recession, the largest recession, hurt this industry very low. And it catch back and is even bigger. One important story here is Intel. But overall, it's not only Intel, it's doing very well. However, it's level off. And part of this level off has to do with the strong shekel, but the second part, more important, is the slowdown of the world trade and the slowdown of the growth of the European and especially the US. You can see that what is called medium high technology, which is less high technology, hurt much more, coming back, but it's not really growing at the same, and it is not higher. And if you look at the medium low, the same story, and the traditional are very small. So this was the engine of growth of the Israeli economy throughout this period. This engine of growth is keeping a high level, but is not growing at the same rate. That's the story. And that's the story of the economy, and that's actually the strength of the economy, but it's also the weakness of the economy, because this is only 10 to 15% of the total labor force. And you cannot have the entire country to grow only on one segment all the time. And ask the Finnish about Nokia, and we have more than just Nokia, but that's the story of the economy. The mix have changed, as I mentioned before, as you can see from 95, high technology was 37% of export, it's now 47, etc. I mentioned that. I think a key point is to look at labor productivity. Output per worker in the Israeli industries. And what you see is that has been improvement, but overall it's still low. So what you have here is the productivity per worker in Israel relative to the US. And what you see is that actually in the low technology industries, Israeli workers produce 43% of what a US worker produces. In the high tech, it's also only 83%. That's what we have to make it higher so we can pay higher wages. We can make it in these industries as well. And if you go to services, it's even worse. So the question is how to improve it. So one way to think about how to improve it is just to increase the capital stock. And what you can see is that if we look at the capital stock, we are having in this industry, beside the low technology industries, per worker, more capital stock than in the US now. So it's not the story of capital. It's not having more capital. It has the two other things which make productivity higher. One is innovation, and the second one is the quality of the work. And we are not doing good enough in the quality of the workers, and we are not doing good enough in terms of innovations, especially in the, not the high-tech industry, but especially in the other industries. There has been a groan here, which we are not sure whether this was a mistake in the numbers or not, a small sample here. But that's, I think, the story. We don't have here the human capital, that's hard to measure, but that's the story of the Israeli economy. Education, technology education, and innovation, which is missing mainly in these industries, in the rest of the industries. High-tech is doing well, and that's also spread out not only in the industries, also in the services. So here we have a comparison over time. I will jump over it, and I just want to finish with a few words. Another thing that's going on is the movement to China. You can see that we are moving from 2000 to 2011. Asia become 16 to 19%. It's not fast enough. We are in the center, we are close to Asia. We can really grow faster by looking at what is needed in these growing economies, and we should invest more in innovations and new products that are needed in Asia. In terms of expenditures on civilian R&D, we are doing very good. We are actually have total to GDP, total to investment, more than other countries. These numbers are 2010, and you can see we are doing 4.3% of GDP, and that's the rest of the OECD countries. So that's very nice. However, a lot of this has to be based on what has been done in the past. It has been growing. It has been based on patents. Israel is ranked number 4 in the world in patent per capita. Number 2 in biopharm patent per capita. There is a lot of activities which are outstanding. However, and that's what I want to emphasize, the role of the government has been decreasing relative to the economy. What you see here is the total spending of the chief scientist in leveraging private investment in R&D and innovation. It has been 2.2 billion shekels in 2000. It's now 1.5. That is the priorities. And that's a big mistake, because the government money is a seed money for startup innovations where the private sector built on it to leverage it. And that was the story of Israel, of Keren Yozma and other things, and the activities here, which was even higher relative to the economy in the year of the 90s. It takes a lot of years to build up new products. It takes a lot of years to cash in these new products. This is, I think, a wrong strategic decision of Israel, which to some extent we pay and we will continue to pay price in terms of potential growth, especially that we haven't used the money here, which is mainly going only to the high-tech, to invest more and more in R&D in the low-tech and the medium-tech industries. Innovations is basically, and I want to congratulate you, innovations is the source of human growth in the last 200 years. And it is the source of potential human growth in the next 200 years. And the government should be a partner with the private sector of investing that. And here in this graph is again the slowdown. So summary, the Israeli economy has been stable, growing well, due to stable macro fundamentals, improving world trade and trade incentives, innovative and growing high-tech sector. This is the past. The recent development shows slower growth in high-tech and the economy. How could policy enhanced growth provide more incentive for innovations? Have a great conference, and thank you for having me.